Alright, it's bonus time from JSNIP4, education time. And this is going to be about what happens when the Fed raises interest rates, ultimately. We know that's going to come. I understand Janet Yellen, as I'm doing this video at 5:15, is currently giving a speech talking about some policy. I thought we just had a speech last week and you said you weren't going to change rates. Now you got to come out and have another speech today? That's odd. Not sure what she's going to say. But having said that, we know interest rates will ultimately rise. I mean, that's what they have to do. So, two things. What happens to bonds when interest rates rise? People who invest in bonds. And what happens to the stock market when interest rates rise? First, we're going to start with bonds. What you should know. This is courtesy of investingbonds.com. Rising rates and your investments. What you should know. The bond markets are extremely active, with interest rates constantly changing in response to a number of factors, including changes in the supply and demand of credit, Federal Reserve policy, fiscal policy, exchange rates, economic conditions, market psychology, and above all, changes in expectations about inflation. So we have some key words in here: Federal Reserve policy, fiscal policy, economic conditions, market psychology, and what was that last one? Expectations about inflation. Mostly what's talked about by the Fed. And I think she's going to cover that today. As a matter of fact, inflation. Question: now that interest rates have started to rise, and this is just a proposed question, they haven't actually started to rise, how will that affect bonds? Answer: interest rates, which recently hovered at their lowest level in 40 years, are rising. Just as bond prices go up when yields go down, the prices of bonds you own now will generally drop as yields, interest rates, go up. Question: when rates go up, do all bonds lose the same value? No. Changes in interest rates don't affect all bonds equally. Generally speaking, the longer the bond's maturity, for example, a bond that matures in 10 years versus one that is in 2 years, the more it's affected by changing interest rates. A 10-year bond will usually lose more of its value if rates go up than the 2-year note, which means if you had a 10-year, you'd probably want to get rid of it, right? Keep that in mind. What should I do as interest rates rise? Should I hold on to my bonds or sell them? Answer: if you buy a bond and hold on to it until it matures, so if you have a 10-year bond and you wait 10 years to cash it in, as many investors do, they say, rising rates won't have any effect on your income you receive. You simply redeem your maturing bond and get back par or the face value of the bond. So if you had a $1,000 10-year bond, at the end of the 10 years, you get your $1,000 back plus the interest it accrued during that time period. However, if you sell it in advance of that 10 years, you might take a hit. He says, example 1, buy and hold. In this example, you buy a 10-year treasury note with a face value of $1,000 and an interest rate of 4.26%. If you keep the bond until it matures, you'll receive $42.60 each year for 10 years, plus the original $1,000. What happens if rates go up and I need to sell my bonds because I'm struggling or got to move some money around, I'm hurting, which is what always happens? What happens if rates go up and I need to sell my bonds? If interest rates go up and you need to sell your bonds before they mature, you need to be aware their value may have gone down and you may have to sell at a loss. Remember, bond prices move in the opposite direction as yield or interest rates. Here's an example again provided by Bloomberg. Example number 2, sell before maturity and interest rates have gone up. An investor buys a 10-year note, same thing, $1,000, interest rate of 4.26. If the investor sells the bond before it matures and interest rates have risen 2%, so we're at 6 point something percent, he or she would only receive $863 plus any interest paid prior to that sale, instead of your full $1,000. so you take a loss. So I'm going to stop there for that part. How does it affect the stock market if interest rates rise? From Investopia.com. How interest rates affect the stock market by Jim Mueller. Mueller. Not Bueller. Mueller. Ferris Mueller. Interest rates. Most people pay attention to them, and they can impact the stock market, but why? In this article, you will learn why. The interest rate. Essentially, interest is nothing more than the cost someone pays for the use of someone else's money. Homeowners know this scenario quite intimately, blah, 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 blah. The interest rate that applies to investors is the Federal Reserve's funds rate. That's what Janet Yellen talks about raising the rates and whatnot. This is the cost that banks are charged for borrowing money from the Federal Reserve banks. Why is this number so important? It is the way the Federal Reserve, or the Fed, attempts to control inflation. Inflation is caused by too much money chasing too few goods, or too much demand for too little supply, which causes prices to increase. By influencing the amount of money available for purchasing goods, the Fed can control inflation. Other countries' central banks do the same thing for the same reason. Basically, by increasing the federal funds rate, the Fed attempts to lower the supply of money by making it more expensive to obtain. Effects of an increase. When the Fed increases the federal funds rate, it does not have an intimate impact on the stock market. Instead, the increased federal funds rate has a single direct effect. It becomes more expensive for banks to borrow money from the Fed. Increases in the federal funds rate also causes a ripple effect, however, and factors that include both individuals and businesses are affected. The first indirect effect of an increased federal funds rate is that banks increase the rates that they charge their customers, you and I, to borrow money. Individuals are affected through increases to credit card and mortgage interest rates, especially if they carry a variable interest rate. This has the effect of decreasing the amount of money consumers can spend. After all, people still have to pay the bills, and when those bills become more expensive just by this rate changing, households are left with less disposable income. This means that people will spend less discretionary money, which will affect businesses' top and bottom lines, that is, revenues and profits. Therefore, businesses are also indirectly affected by an increase in the federal funds rate as a result of the actions of the individual consumers, as just mentioned. But businesses are affected in a more direct way as well. They too borrow money from banks, not just needing money coming in from their customers, but they have to borrow from banks to run and expand their operations. When the banks make borrowing money expensive, companies might not borrow as much and will pay higher rates of interest on their loans if they do so anyways. Less business spending can slow down the growth of a company, resulting in decreases in profit. Stock price effects. Clearly, changes in the federal funds rate affect the behavior of consumers and businesses, but the stock market is now also affected. Remember that one method of valuing a company is to take the sum of the expected future cash flows from that company discounted back to the present. To arrive at a stock's price, take the sum of the future discounted cash flow and divide it by the number of shares available. This price fluctuates as a result of the different expectations that people have about the company at different times. Because of those differences, they are willing to buy and sell shares at different prices. If a company is seen cutting back on its growth spending or is making less profit, either through higher debt expenses or less revenue from the consumers, then the estimated amount of future cash flows will drop, and many times drop significantly. All else being equal, this will lower the price of the company's stock. if enough companies experience declines in their stock prices, the whole market or the indexes like the Dow Jones, etc., S&P, that many people equate with the market will go down. I'm going to stop there because there's a lot more to that. And if that starts happening, the rest of the market picks up on it. Remember that whole market sentiment and all that? And everyone starts selling everything, i.e. creating 1929 all over again, stock market crash. So then you take into that effect, people not buying and spending more, businesses not expanding because they can't, because the customers aren't buying as much from them. At the same time, the business can't expand if they wanted to when they had plans to do so, and they set aside a certain amount of money to do so, which now became, not necessarily set the money aside, but maybe set a system in place. And okay, in 2 years we got a growth plan. In 2 years we'll go to a bank and we'll get a $300,000 loan. We'll take that loan, we'll do this and that. All of a sudden, okay, we're there, it's 2 years, ready? Oh, we can't, rates just went up. Throws our whole monkey wrench in our plan. We can't do this right now. We have to cut back and wait, or save up the cash on our own. And if we save up our cash on our own, we got to get that from the profits. And right now profits aren't looking good because a lot of consumers are no longer spending. So you have a massive trickle effect by these people playing games with the interest rates, and they brought them all the way down to damn near zero. The Federal Reserve. It can't go any lower unless they go negative, which means we're going to start charging you guys to like hold your money in the Federal Reserve, or start charging consumers to hold your money in the bank. Oh, it's negative interest rate time. You got a certain amount of money in the bank, we're going to send you a bill, which we'll just take it out of your account, just for storing your money, which is going to cause people to say, I'm not storing hardly any money with you, maybe enough to pay a couple bills that I can't go and write a check down the street for. You can charge me your little 1% fee on that. But the rest of my money I'm taking out and I'm keeping in my house or whatever. So you'll have a bunch of people taking their money out of the banks. And if a bunch of people take their money out of the banks, then that means the banks don't have the reserve requirements met by the Federal Reserve that are put in place by their rules to have out all these loans. So what happens when, as of today, you do meet the reserve requirements, but next week you don't meet the reserve requirements, but you already made the loans are already out there, they're already there, you can't call in the loans. Now you're not in compliance with the Federal Reserve rules. And they state, you better find a way to get some money. You better raise some funding. And they have to go figure out a way to pull in some money, some investors. And if they can't, you start to have banks closing. They'll have to close the doors, be shotgun married off to another bank. The DIF fund, which is run by the FDIC insurance, will split the cost usually with some other bigger bank that scooped up the bank that failed. And how much of that can the system take happening all at the same time? I just see a recipe for disaster. I was talking to my buddy Frank today at lunch. I said, look, today's the 24th, yesterday was the 23rd. Nothing at all has happened. No meteor nonsense, none of that crap. No terrorist attacks, right? Nothing has happened. And I said, you know what? Let's just pretend for a moment that whole 9/23, 9/24 date never even existed. The movie stuff, YouTube people, nothing. It never happened. No one even knew about it. We had no clue. Never existed. I said, just pretend that that's where we're at right now. Let's look at some things that are factual, that apply right now, even though we took that little conspiracy thing out of the way. We've already tapped out, we're topped out, $18 trillion, time to have another congressional kick the can session due before or on October 1st, or else the government shuts down, as they say. And the first thing to get cut is, this time around, food stamps. That's still a problem. We still have this enormous debt we can't pay off. As I just said, we're going to have to either raise it again, go to 19 trillion, go to 20 trillion, go somewhere, kick that can down the road some more. We have all these interest payments on our debt. Like I was just telling you, the bonds, you get a 10-year bond, you make interest on it for 10 years, then you turn it in, you get your full investment back plus the interest you made over the 10 years. The same thing applies when the Federal Reserve prints money. They can't just print money and say, here you go, Congress, use it for whatever you want. The rule is, you guys got to print however much you need $10 billion printed right now, you need to put $10 billion in treasury bonds out on auction. Okay, we got the buyers. Okay, well, here's your $10 billion. And the people who essentially bought those bonds are now making interest payments over the years. Every single year. You got a 2-year bond, you got a treasury note, you got a 10-year treasury note. For 10 years, we're giving you this interest payment. And then at the end of the 10 years, you turn in that bond, we give you the full amount back. So just for this example, a very, very, very rich person gives the government $10 billion, essentially, for that $10 billion bond, because they're going to make interest on $10 billion for the next 10 years. Even a few percent interest on $10 billion coming in every month, every year, whatever it is, which, let's look at it every year. I don't know the exact math at this point in my head, but it is a nice, huge chunk of change for the person who put up the money to buy the bond. The problem is, the rest of us are paying that person the interest. And then when he cashes out the $10 billion at the end of the 10-year term, he gets that from us too. So if the Federal Reserve is printing $10 billion in cash, who's printing the interest payment for those 10 years? The Federal Reserve's not really printing it. They only print the principal. So you have the interest rate constantly, or not the interest rate, but the amount in interest being paid constantly stacking on top of itself, growing and growing and growing, which is why none of these debts of any of these countries, including the United States of America, can ever be fixed. You can't pay off the debt. Because if I print $1, but it costs you $1.02 to use that dollar, how does the 2 cents come back to me if I've only given you $1? It can't. So we have to use other money from other sources to buy that, convert it to our currency, all this nonsense, and make interest payments. We never pay back the principal and interest. We can't. We pay back that person the interest and then his principal when he asks for it, which is why 7 trillion turned to 9 trillion, turned to 12 trillion, turned to 14 trillion, 16 trillion, and now 18 trillion topped out. In just a few short years, $9 trillion has turned into 18 trillion. We're tapped out again. We need to have another discussion again. We got to raise the debt ceiling again. We have Catalonia. I told him this today. We have, including, again, back to pretend the 23rd and 24th conspiracy crap is gone, never even existed. Catalonia, Spain. We're essentially seceding from Spain. We're making our own country. That's being voted on like today or this weekend, I think. Like, I want to say it was today for some reason, but now let's just say they're ready to leave the country. Greece voted again for the Syriza party, who said we're the remainder of the original party you voted for, who promised he wouldn't do the things he did, and did them anyways, and agreed to more austerity, and then stepped down and said, I quit. We're the remainder of that party that told him not to do it, so trust us, vote for us. We're not going to do it this time. We tried not to do it last time, and they won. The people in Greece have just voted, and they won again. Is Greece about to leave the EU? Because again, if we hear the news, oh, okay, Greece just left the EU here shortly, I think that's going to be domino after domino after domino. We have Puerto Rico, $70-80 billion. We can't even come close, not even going to try to pay it back. Back to Greece. They owe a few hundred, I think, billion in total. Couldn't pay the first 80 billion, whatever it was, 100 billion. Let's give them another 100 billion. How about a third 100 billion? While they gutted Greece's infrastructure and privatized it and sold it off, which amounted to nothing anyways because the people are still suffering. Nothing got fixed. So you have all these things happening. You got Brazil, as I just said yesterday, it was 4-1 with American dollar. As of this morning, I looked at it, it was 4.2. It went up 0.20. So in dollar terms, what used to be $100 US was $100 Brazilian currency. It now takes you 400 Brazilian dollars to make 100 US dollars or convert. And as of today, it took 420 from just yesterday being 400. It now took 420 in one day. Which means, back to gold and silver, as I said, if you were holding gold and silver in Brazil, you'd be smiling as this was happening. Hey, keep going. How about 5 to 1? How about 6 to 1 to our currency? My gold and silver is going to explode. Wow, I was just doing this to save my financial livelihood, and I'm going to make a small fortune in the process. Great. I don't have to be out there beating pots and pans and demanding the resignation of this president or that president. I've got news for all of you bozo sheep. Should any of them be watching my channel by chance? It doesn't matter who the president was or will be. Why? Because of what I just said. They all practice fractional reserve lending across the world. They all create bonds that have interest on them in order for themselves to fund themselves, which are exploding right now, and they're having to deal with that, and people are flooding, to sell off their bonds. The government has to deal with that. We don't even have money to deal with this. How are we going to have money to deal with buying the bonds back? And what ultimately is going to have to happen is they're going to have to mark down those bonds. And then the bondholders are sitting saying, "Oh, that hurt. That really hurt." Which then tells everybody else, don't trust in this particular country's system, because their bonds, they just defaulted on them essentially by destroying the value of them, making us take a haircut, so we don't want to invest in that country anymore. You're not going to trust that country anymore, then that country's in deep trouble. You got Venezuela, Argentina, again, Brazil. They're protesting out of control right now in Brazil. Rightfully so. Their currency's just been destroyed. What did Gerald Celente say? Currency wars, trade wars, real wars. And that, my friends, is it for JSTEP 4. Take care.